Everybody's looking for an analog. Like, what does this look like? And there's some late 1920s, early 1930s here. You got some definite mid 80s, 99. There's something for everyone, but there's also some semblance of 73, 74, which is something you've tweeted about. And can you speak to that? I mean, does this line up in similar fashion as we saw some 50 or so years ago?
There's definitely an analog to the 73, 74 bear market. And that was a bear market that the stock market peaked in January 73. It ended up falling 47% to October of 74. What's interesting about that cycle is that the Fed was raising rates throughout the bear market. And earnings kept growing throughout the bear market in nominal terms, of course. And of course, that's partially an illusion based on inflation. And then the market bottomed and earnings peaked, but the Fed, was able to lower rates, and so it was a weird cycle in that sense, where price really bottomed about a year before earnings. And so the early 70s, it was an unusual bear market in that sense, because usually the Fed is not pushing rates higher throughout the entire thing. Towards the end, when the Fed pivots, oftentimes the damage is done and earnings start to fall and price falls. I actually recently did a study, which you'll see in my Twitter feed probably next week, that of the 16 cycles since 1950 where you had the last tightening of a Fed tightening cycle, about 11 or 12 of them produced a bear market. Some of them did not. The market was able to rally right away. But the 70s kind of stuck out. But the other analog that I've been focusing a lot on, even though that era was in many ways totally different than today, was the 1940s. 1942 to late 1940s. That, of course, was the period where the U.S. entered World War II. Of course, we don't have a World War today, thank God. We also have a completely different demographic makeup, right? That was the start of the baby boom generation. We're kind of on the baby bust side. But 1942 to 46, as the U.S. mobilized to enter World War II, there was this massive fiscal response, right? Because that's what the government was doing to get the country ready. Debt to GDP tripled from 40% to 120%. And the Fed, which was not yet independent at the time, was tasked with monetizing that debt. So the Fed increased its balance sheet tenfold and capped bond yields at 2.5. Now, the Fed isn't doing that today. And the policy response was presumably not explicitly coordinated, but who knows? But that 1-2 punch of fiscal and monetary, the last time we've seen that before COVID was the 1940s. And then when the war ended, in the same way that COVID sort of ended, or at least became an endemic instead of a pandemic, the GIs returned, the economy had to be resuited for that purpose. You had supply chain bottlenecks. Inflation went to 20% in 1946-47. You had a 28% bear market, just like we've seen so far, 28%. But to your point about kind of this frustrating sideways reset period, was that it took 3 years for the market to finally start a new bull market. And it's interesting that earnings didn't skip a beat, but in part because inflation was 20%, but it was all valuation. The PE went from 22x to 5x. The market, after falling 28%, had several 15 to 20% rallies, but they were all given back. And then the lows held, and you had this kind of several year-long trading range. And I'm not predicting we're going to have a several year-long trading range, but it is an example where rather than this binary bullish or bearish outcome, you had something in between where the market just has to digest a changing landscape, whether it's from low inflation to high inflation, lower rates to higher rates, or higher PEs to lower PEs, or even just the leadership change from the FANGs to everything else.